Welcome into the Money Wisdom Podcast, powered by Johnson Bernetti. We have another exciting episode for you today. If you're tuning in for the first time, my name is Jake Dozer. I'm a certified financial planner on our team in Connecticut. And then I'm joined, of course, by my partner in crime across the screen divide there. Nick, will you introduce yourself?
I sure will. Thank you, Jake. Viewers, listeners, welcome back. I'm Nick Colantuono. I'm a certified financial planner up here on the team in Boston. It's getting cold out there.
Baby, it's cold outside. It's past the season. Never mind. So we have a question here in front of us today that apparently evolved out of a Nationwide Retirement Institute survey that was done. And the question is, it was titled, "What 59% of retirees wish they'd known about taxes?" That's interesting. That grabs my attention, at least. And here's what it said: is synopsis of the article. If you're not a reader, is 59% of respondents said that they regret not preparing for how taxes would affect their savings in retirement. And I think that, frankly, it's probably a larger percentage of folks that we meet with that have not considered the impact of taxes on their portfolio. We have a few things here from the article that we see, folks are surprised by, they're sidelined by when they're thinking about the tax impact. And then we've got some things that we've prepared are ways for you to be able to address this taxation that's coming your way, whether you like it or not. So without further ado, let's hop into it, Nick. The first thing that the survey mentions that folks are frustrated that they are discovering too late is that Social Security benefits are typically taxed up to 85%. What does that mean? Help us to understand that, and then help us to understand what that means for us within the larger retirement planning conversation.
Yeah, it's a great question, and it's no surprise that that's a big concern or something that catches a lot of retirees or a lot of people who are now collecting Social Security off guard, because it's something that is very rarely talked about as you're preparing for Social Security. Everyone looks at their statement and they see, oh, I'm going to be getting $3,000 a month. That's great. I could use $3,000 a month. But then when push comes to shove and you have to pay your Medicare premiums and you have to have taxes withheld, and then you only get $1,500, and you're saying, wait a minute. I wish I had prepared for this a little bit more. So, to get to the core of this study, it can be confusing. And especially over the last year, where there's been a lot of legislative change when it comes to Social Security, I'm having conversations with a lot of people who are coming in and saying, oh, President Trump got rid of taxes on Social Security on the federal level. And it's like, well, that's not really true. So, I get it, folks. There's a lot of places to go for advice. There's a lot of information that gets thrown at you. There's a lot of noise out there. So what it all comes down to is make sure that you've got somewhere to go where you're getting information on this stuff, and just make sure that that information is specific and tailored to you. So yes, right. Social Security on a federal level is certainly subject to tax. And based on how much other household income you have, up to 85% of your Social Security benefit could be subject to your federal tax rate. So you really need to make sure that you've got a plan in place, because you want to know not only what's coming in before taxes, but what you're actually getting direct deposited in your account to live your life with on an after-tax basis. That's the kicker.
Yeah, in a large sense, you need to know your gross income. You need to know your net income. You need to know those just to do some high-level planning. Then you have to know what your adjusted gross income is. For Medicare, you have to know what your modified adjusted gross income is. And all those numbers could potentially, and most often are, different depending on the income source, depending on the amount of that income, depending on your age, depending on whether, so many different things.
Your various deductions, right.
You need to be aware, number one, when you apply for Social Security, they don't automatically take out taxes. You have to ask them to take out taxes using a form called W-4V. Then they don't offer to take out state taxes. So if you owe state taxes, you have to figure out that yourself, number one. Number two, you have to withhold it from another place or make estimated tax payments or quarterlies. And it, depending on the state you live, dictates whether it's taxed at all at the state level. In the state of Connecticut, if you're single, it's If your income is below $75,000 of adjusted gross income, then Social Security, pensions, IRA withdrawals, and annuity withdrawals are not subject to state income tax. If it's above that threshold, it is subject to state income tax. Married filing jointly is $100,000. Massachusetts has different rules. Every state has different rules. So, man, there's so many moving pieces. Be aware of how that taxation is going to impact you, because what you care about most is the bottom line. How much money are you going to see hit the bank, and can that sustain your lifestyle? And are you making the wise overarching decisions regarding tax mitigation through tax planning? And you're going to need to know all those pieces. So, don't allow that to overwhelm you to the point of indifference or apathy or lack of decision, but allow it to say, okay, this is a lot of moving pieces. Am I going to figure this out myself? Do I need help? Who am I going to get help from? How am I going to be proactive about this? Those are the questions you should be asking yourself as it pertains to taxation of Social Security at minimum. And we haven't even talked about the other three. So without further ado, next up is required minimum distributions, RMDs, can push you into higher tax brackets. Now, Nick, I don't know about you, and I've never said this to you, so I truly don't know about you. I think that RMDs and the taxation in the latter part of retirement are probably the most insidious tax bomb on folks' retirement plate. Would you agree with that? What are your thoughts on RMDs and how we can avoid them?
Yeah, I completely agree with that. I often refer to the 401ks and those tax deferred retirement accounts as ticking tax time bombs. Everyone listening and viewing and watching, folks, you're doing exactly what you were told to do, and you were saving that money for a rainy day, and you didn't pay the taxes on it. Now when you're in the high earning income years, you're deferring those taxes, you're getting deductions, you're letting the money grow until the point comes where you actually take it out. And then the point comes where you actually take it out. And more often than not, folks are shocked to see the taxes that will ensue. One is we have to think of the tax environment that we have right now. And if you had to ask yourself, well, are taxes going to be higher or lower in the future than where they are today? I think most people would lean towards the fact that taxes are probably going to be higher. And if that's 10 or 15 years down the line, well, taxes are probably going to be pretty significantly higher. So a lot of people aren't necessarily thinking about, the point where they're withdrawing money. They're just thinking about the short-term benefits of making those contributions and getting the deduction on today's income as a result. So, very rarely is Social Security the only source of income that our clients have. So whether it's required minimum distributions or whether it's distributions that our clients are voluntarily taking out of their retirement accounts because they need money above and beyond their Social Security to live their life, you need to be mindful that all these different streams of income you have are going to result in taxes on your Social Security. And furthermore, it can also impact the other things that you pay for, like your Medicare premiums or just general other things that you have to be aware of. So it's all a big puzzle. And it's not just the retirement distributions. It's not just the pension or the Social Security, but what about the interest off those CDs or the cash that you have in the bank? Or what about the dividends that inherited stock that you received have been generating, year in and year out? So again, you really need to make sure that you're looking at everything from the 10,000 foot view, because that'll allow us to then systematically, zoom in and zoom in and zoom in, and then figure out how we need to be navigating the taxes in retirement. And I say, pretty much in all the conversations I have, the difference between just investment management and really the work that we do, Jake, for our clients as financial planners, it lives all in the tax planning that we're doing. Now, of course, we have to preface that by saying we're not accountants, we're not CPAs. We have accountants and CPAs on staff for the benefit of our clients, but you need to be very mindful of not just how much money you have or what your rate of return is, right? The oldest saying in the book is, it's not just how much you earn, it's how much you keep. And in retirement, it is all about how much you keep, how much income you have coming in to actually afford the life that you want to live in retirement. So connect with someone, folks, put a plan in place for this next phase of life, because it is, nothing like the phase of life that you're coming out of if you're trying to navigate that transition from working into retirement.
That's right. It's different objectives, different phase of lives come with different relationships with your money. In the pre-retirement stage of life, it might be all about grow, baby, grow. And it also might be about deferring all the taxes you can. And then you enter retirement, and now maybe it's all about preserving and modest growth and income creation. And maybe it's about addressing the taxes, but it's never about avoiding the taxes entirely. Because taxes are not something to be avoided. They're something to be your relationship with which is managed. So what that means is don't defer taxes indefinitely. Figure out when the best time is to pay the taxes, how much to pay, the frequency of payments, and the method of payment. That's what tax planning is. It's not reactive. It's proactive. How do I, from now until the time I'm gone, or maybe even beyond the grave when my kids receive the money, how do I pay the least amount of taxes? That is a better question than do I want to pay taxes or not? Because we know the answer to that is no. But you can't avoid it entirely. And then the final thing to be aware of, we mentioned Social Security taxation. We mentioned RMDs pushing you into a higher tax bracket. We mentioned Medicare premiums being impacted. Not only do you need to think about your tax bracket threshold, you need to be thinking about your IRMAA threshold when your Medicare is impacted, which goes back to that modified adjusted gross income thing I mentioned earlier. And then you need to think about selling stock or investments within brokerage accounts or non-retirement investment accounts. We see some common mistakes with that. Nick, what are some of the mistakes that folks are making with taxable brokerage accounts, whether they hold stock, ETFs, mutual funds, bonds, whatever it may be? What are some of the common mistakes we're seeing folks make that they step into and they can't get their foot out of, so to speak?
Yeah, I mean, our philosophy whenever we're managing money in the taxable world is first and foremost, the focus has to be on tax efficiency of those assets. And more often than not, I just see there's a lot of problems there because, some folks have owned those vehicles for a very long time. Meanwhile, they could be like the least tax efficient vehicles to own, but if they were to sell them, they'd have a big tax impact. So, one of these problems are just almost continuing to fish when you should cut bait. And I reference that a lot because a lot of people are very hesitant to pay taxes. And the taxes I'm referring to are capital gains. Paying a capital gains tax just means that you won the game and that you did very well. And if paying that tax today means we can get you into a more tax efficient approach with the investments going forward, well, okay. You made money and you had to pay taxes because you did well. Well, that's great. And now over the rest of your life, you can more efficiently manage that money from a tax standpoint. So, fish or either fish or you cut bait. And oftentimes when it comes to those taxable accounts, although it might be a little painful in the near term to have to pay those taxes, it's going to mean a much better situation, year in and year out going forward. So one of the big mistakes we see is just continuing to hold some of these legacy positions, even though they may be spitting off some pretty, negative taxable distributions, and just not owning the right stuff. And again, how would you know if you don't do this for a living? So, come in, have these conversations, just get a second opinion on what you're doing. And then you be the judge if it makes sense to make some of these changes.
That's right. Well, as always, we do want to offer you a resource. Obviously, listening or watching this, unless you're taking copious notes or transcribing, is not going to be as effective as being able to see it in hand sometimes. Sometimes those things partner well together. So without further ado, I want to mention we have a resource we've put together called Are You Paying Too Much in Taxes in Retirement? If you'd like to get the Are You Paying Too Much in Taxes in Retirement booklet in your hands, we'd be happy to send it to you free of charge. Simply text the word OFFER, OFFER, to 800-757-0436. You'll see that keyword and phone number in the show notes below as well. Moving on, we've talked about some of the things that folks see or are hit with too late in the game from the survey that we cited earlier. We also are talking about, okay, so here's the pitfalls. What are some concepts we can implement to avoid those pitfalls? So one of the conversation items that should be on the table really of everyone, whether you implement or not is different, but something you should be talking about is Roth IRA conversions. Nick, what are some of the ways that Roth IRA conversions can help us, and what are Roth IRA conversions?
You bring up a good point. I mean, the Roth IRA conversion is one of the kind of hot topics that folks come in with questions about. There's a window of opportunity that exists, especially for a lot of our clients who are transitioning out of these high earning income years into their retirement years, where in all likelihood, their income is going down. That is something that I'm often having to talk to people about taking advantage of. You know, the idea of a Roth conversion is you're taking money out of those tax deferred retirement accounts. Yes, you pay taxes on it when you do it, both at the federal and state level. It hits you as income. But then what you do, instead of putting that money in the bank, is you can put that money into a Roth IRA where it then grows tax-free for the rest of your life. So a lot of people like the idea of that because having that Roth money gives them the benefit of tax-free growth forever. It also gives them the flexibility of taking tax-free distributions in retirement, which is great. And it also allows them to know that if that money gets left behind and goes to their beneficiaries are also inheriting that money tax-free. So there's a lot of benefits. But the cost of doing it is the hit that income will have on your taxable income in the year in which you do the conversion. So it's really something that people need to plan for. And it doesn't make sense for everyone, but it's certainly a conversation that everybody needs to be having. There's a really good window of opportunity that exists for our clients to be doing these Roth conversions right now.
And there are so many different moving pieces, folks, you know, whether it be Roth IRA conversions, timing the withdrawals that you're taking to make sure that it's not at a time that's a higher tax season of your life, making sure that your investments, the right investments, are living in the right accounts. So let's say, for instance, you're not touching your taxable brokerage account and it's something that you're delaying using until the latter part of retirement. Well, then why are we chasing dividends or interest generated within that account, which are taxable as you build the money? Why aren't we just building for the long term as opposed to creating tax drag in our portfolio? It's questions like this: is where can we shift your investments to be giving you more tax efficiency? And there's so many more things there, but you know, one of my favorite segments I want to get to is our mailbag minute, which is where we kind of go through rapid fire, some quicker answered questions that we can throw out there. So question number one, Nick, we have for mailbag minute is about retirement contributions. This person says, I'm 42, I'm making under $40,000 a year. What percentage of my income should I contribute to Roth?
We would really need a lot more information to be able to answer that. But on the high level, it's just hard. It's hard to say. I mean, the idea behind contributing the money to the Roth is that you pay the taxes now. And given your age and your income, you're probably in a fairly low tax bracket, a favorable tax bracket, where the recommendation I could see being pay the taxes now and never pay the taxes again. But at the same time, we also have to determine how much other money you have in retirement accounts, because if in your retirement years, your income is going to be such where it could, in theory, put you into a higher tax bracket than the one you're in now, well, maybe you're better off taking the deduction that the pre-tax contribution would give you. So unfortunately, it's something that we can't answer in a forum like this, but I can appreciate where the question's coming from.
Gives them some good things to think about is what factors go into the way you can answer that question. Next question is focusing on 401k rollovers. I'm 70 years old. Can I roll my 401k into an existing traditional IRA without penalties or taxes?
Yes, you can. Now, there are some reasons you might not want to do that. Primarily, if your plan is to continue to work and this 401k money is with your existing employer, leaving that money in that employer-sponsored plan will remove it from the required minimum distribution calculation so long as you're continuing to work. But if you're 70 and you're planning on retiring now, or maybe you're already retired and this money's from a previous employer, yeah, take that money with you. You can roll it into an IRA, no taxes, no penalties.
Last but not least, about gifting. I would like to make a gift to my college using my RMD, my required minimum distribution. Is there a way to transfer the money directly and avoid paying taxes on it?
Jake, like most of these questions, that depends. If your college is set up as a charitable institution, a 501c3 charity, yes, you can make that RMD, or you can take that RMD, gift it directly to the institution and not pay taxes, as long as it's under $100,000. In most cases, if you're making that gift, you're going to have to realize the RMD. The money's going to have to go into your bank account, and then you can do whatever you want with it. And if that's write a check to your former college, sure, feel free to do it. But you might still have to pay the taxes on it. There will not be penalties, but typically if you take an RMD, there are going to be taxes associated.
Well, folks, hopefully today's episode has been helpful. If it was, be sure to like this video, subscribe to this channel, or share it with a friend if someone else would be of benefit. We hope today's episode has been helpful. From Jake and Nick with Johnson Brunetti and the Money Wisdom Podcast. We'll see you next time.
Johnson Brunetti is a marketing name for the businesses of JB Capital and JN Financial. Investment advisory services offered through JB Capital LLC. Insurance products offered through JN Financial LLC.